G'day folks, it's Jim here from Orchard Forex, and it is Saturday the 8th of May, and the markets have just finished, and we saw a huge miss on Friday in the non-farm payrolls, which added just 266,000 jobs as opposed to the expected 1 million, and this led the US dollar very sharply lower, really, commodities higher, and the S&P and the Dow Jones both finished at new all-time highs, with the prospect of any tightening of Fed monetary policy evaporating along with the numbers. On top of the poor non-farm payrolls numbers, the headline unemployment rate, which had been expected to fall to 5.8%, actually jumped from 6 to 6.1%, with the two sides of the US political divide coming up with their own reasons as to why this happened. Anyway, the outcome seems to be for a much longer and much slower recovery in the US, and this should keep the current theme running for quite some time. So we'll go and have a look at the charts and see what we might expect from them from the week ahead. And at the end of the video, we'll go and have a look at the calendar. Okay, so we'll start with a daily chart of the dollar index, and this time last week we were expecting some early week mild US dollar strength, and we did see that, probably not as much as we were hoping for. The dollar basically stopped ahead of 119.5 in the euro. It got up to this sort of 91.50 level, and then just moved around sideways really for most of the week until the non-farm payrolls on Friday. And if this is a genuine channel, we've actually closed below it for the week. And I think now with the daily indicators beginning to point lower, we're probably going to ratchet towards the downside still. And I think further dollar strength, further dollar weakness probably does lie ahead. Further out, if we don't look at the weeklies. So this time last week we said the weeklies were beginning to trade a little bit sideways, but really with the move we saw on Friday, that they look as though they're about to turn lower again. So overall I do remain pretty bearish on the US dollar, and I suspect we're going to see some reasonable gains and some reasonable directional trade, I hope, in the coming week. We'll go and have a look at the euro to start off with then. Right, so here we have a 4-hour chart of the euro, and as you can see early in the week we got down to this sort of 119.85 level. I was hoping for it to go a little bit lower, down to this sort of 119.50, possibly even down to sort of 119, 118.80, but we never really saw it there. We then saw this sideways consolidation before the move up on Friday. Now with this move up we took out this minor resistance here, and it really looks to me as though we can now push further on. The 4-hour indicators are positive for the start of the week, and if we can take out the high here, 121.70 odd, we can probably move on to 122 and then to this high eventually around 122.40, with, as I said last week, this high sort of 123.5 being a more distant target. The daily charts, they had been pointing a little bit lower, but Friday's move probably seems to have curtailed that. The RSIs are beginning to point a little higher. So we actually came down, we sat on this 100-day moving average. That provided good support and will continue to do so, I think. So I don't really think we're going back below there now. I'm certainly a buyer on dips, and as I say, looking really towards this level and then this level as targets. As far as dips go now, well, if we sit back below 121, I would suspect that's probably a pretty good place to, and I'd be adding to it and further falls towards 120, with the stop loss on the whole position below sort of 119.5. Once if we broke below these lows here, and I don't think we're going close this week, but if we broke below these lows here, or possibly even the 200-day moving average at 119.5, I'd be out of all the positions. But for the time being, looking to add to long positions to buy dips for further gains over the course of the week. Moving forward to dollar yen, and likewise dollar yen, that saw a sharp move lower and then consolidation for the rest of the day. Really, that traded in line with US bond markets, which saw the 10-year yield fall quite sharply from 1.5 to 1.4, and then come back to close pretty much where it had started. The hourly charts they're slightly they are oversold to start off with, so we'll probably see some consolidation on Monday, but this does look as though it could be a bit of a bear flag for further downside movement over the course of the next few hours. The 4-hour charts are suggesting lower levels do lie ahead. So once again, I think I'd be a seller on rallies. Now we've got this pivot point move really right across here. We've closed just below it. Currently that would lie at around sort of 108 3/4 for 109. Certainly if we get up towards that sort of level, I'd be looking to sell at 109. Stop loss placed above here, so 109.60. Don't think we're going there, but I wouldn't be surprised to see a move back down to this sort of 107.75 and then to this low 107.5, possibly even down towards here 106.88 as the week progresses. The daily charts really aren't showing us an awful lot at the moment. I think there are better things to trade than dollar yen, but if you're involved there, certainly I think I'd rather be short than long. Sterling's beginning to look interesting to me. We've been consolidating really for quite some time, going back towards, well, beginning of end of February, I should say. But maybe this consolidation is about to come to an end. If we're going to see a weaker dollar, we're going to see a higher sterling, and this potentially, we've got a kind of double bottom here, maybe a couple of shoulders, so possibly a break to the top side may lie ahead. And with this double bottom down here, 136.70, moving up to 140, so what's that, 330 points, so that would take us above 143, and it would take out this high here. On the daily charts, well, that if we do go up there, that's to new long-term highs, so it's not going to be an easy run, but I'd certainly quite like the look of sterling. Having said that, the daily charts are not really showing us a great deal at the moment, so until we actually do confirm a move away from this consolidation, they will stay reasonably flat. But like I say, with everything else, sell the US dollar, buy sterling. I think the euro is probably a better trade still, but there's probably not an awful lot in it. Now, if we move forward to the Aussie, that's kind of similar. We've got a neckline here. This is a reverse head and shoulders, I think. We've taken out these previous highs. We've taken out the minor trend resistance. Sitting at 78.40, we actually took out this this previous high back here. We've come to sit basically on it, but I think the indicators suggest to me that we are going higher. And the 4 hours pointing north, the dailies, once again not showing us an awful lot, but I like the idea that we're probably, if this is a reverse head and shoulders, this is sort of 75.40 to 78.40, so that's 300 points. So that'll take us to sort of 81.5 if we saw a measured target off the low to the neckline. So once again, looking to be long Aussie, short US dollars over the course of the week. And the same applies to Kiwi. If we go and look at that, actually before we go and look at the Kiwi, I will go and just check out the daily here. This high here is at 80, just above 80 cents. So we need to actually go back to the weeklies, and here we have the weekly chart. So we're sitting here, we've got to take out this high. If we can take it out, then the next target would be at around that 81.30.40 level, as I said before. Personally, I think we're probably going to get there. I see a couple of the big Australian banks have got their fair value for the Aussie at around this region, really, with iron ore prices and copper prices going through the roof. The banks feel that the Aussie is undervalued, and I suspect they're right, and I think we're probably heading in that direction. So we're going to have a quick look at the Kiwi, which is doing pretty much the same kind of chart formation. Reverse head and shoulders, possibly, not really sure, but the 4 hours are pointing higher. The dailies are they're not doing an awful lot, but we're currently sitting at 72 cents, and basically we've got about a 3 cent measured target, so that would take us beyond sort of 75 cents if and when we see it. And if we need to go out to the weeklies once again, we haven't been to 75 cents since back here, which was in, let me blow that up, which was in July 2017 by the looks of it, this point here, July 17. So that's kind of what I'm looking for over the course of the not the next week, but probably the next month, next couple of months perhaps. But in the meantime, certainly be long rather than short the Kiwi. Now, as far as commodities go, my major focus really is on the gold market. As those of you who saw last week's video, I'm very bullish long-term gold, and finally we made a move on during the latter half of last week. We had been sitting around this sort of 1770, 1780 level, But personally, we were long, and we saw a good run on Thursday, and that was added to on Friday after the non-farm payrolls. Right now, I think we're probably going to sit around here, 1840, 1850. We've had a good run up, and I think we'll probably digest some of those gains early in the week. But I do like it higher. If this 1850, which is 61% of this move down here, I think that'll be good resistance, and I'd be very surprised, really, for the first half of the week at least, if we go above it. We haven't actually got an awful lot of data out this week. There's some inflation data on Wednesday, I think it is, in the States. That might see some movements at the station as far as gold goes. But I think so 1850, 1820 is probably now a reasonable range for the coming week. But I think we should be building a case for a higher gold price down the track. If we were to break above 1850, then this next point of call, so 1875, which is, I need to squeeze this up, which is 50% of the move from the all-time high. So, and we haven't, from the all-time high down here to this 1680 level. So we've come back here, and that will be the 50% retracement. I don't expect to see that yet, but I think we're going to see it in time. And let me just blow that up again. So that's the 4-hour chart. The dailies, just hinting we might be pushing a little bit higher. As long on top of the, we've also got this trend resistance that comes in at 1860, as do the the 200-day moving average at 1860. So I'm not that enthusiastic about being long at these levels. I'd be taking profit as we move towards this sort of 1850, 1860 level. But certainly I'll be buying dips if we saw a move back towards 1800. As far as the weeklies are concerned, the the weekly charts the indicators are beginning to point a bit higher. Nothing dramatic at this stage, so as I say, some consolidation. But eventually, I think, as I say, we're going to go a lot higher. We're going to take out this level, and if you go and look at last week's video, I'll show you a reason why I think we're eventually headed on towards $3,000 an ounce. Oil, I'm not going to go to silver, but oil is not doing an awful lot at the moment. Here we have a daily chart of West Texas Intermediate, and really the oil price is capped below this March high, so 67.20, I think it was 67.70. It's capped below there. The chart's not showing us an awful lot. The 4-hour chart's just moving a little bit lower, but I think we're generally stuck in this consolidation. Ultimately, I like to buy it because I think it is going to go higher. I think eventually we'll take out this level, 66.70. I think we're going to take out this level at 67.70, and my long-term target is for as the US recovers, or as the global economy recovers, I should say, we're probably heading back towards $80 a barrel. That's going to be a while in the making, but certainly if it's at 64.80 at the moment, if we saw a move back down to sort of 62, even $60, I'd still be buying on dips, looking for the next leg higher. But it could take a little while to come about, particularly after those non-farm payrolls suggesting the economy is going to recover at a slower rate than we previously thought. As far as the stock markets go, just briefly, here we have a daily chart of the S&P, and it's the same old story. Buy dips, I think. We've always got the chance of a bit of an accident, but the slow grind higher is going to continue. We're now at 42.20, all-time high, probably heading on towards 42.50, possibly even 4300. Support now should come. If we go back below 4200, I think we can possibly go back to this, or 4100. Let me have a look at the 4-hour charts. So we've got minor support here, 4140, and further support here just above 4100. The rising uptrend line here, that comes in way lower now at just above 44,000. I don't think we're going back there. The 4-hour charts look positive at the start of the week, albeit, as with the usual point, that we have got some bearish divergence. So we should constantly expect setbacks. The dailies equally, as I said before many times, we have got this bearish divergence, and the weeklies definitely are showing some more of the same thing. They're also, the weeklies are pretty overbought, but don't argue with the uptrend, because it's a lot of people have lost a lot of money trying to pick the top on this. So I think my own view, If we want to play the stock markets locally, the Aussie has got a lot of catch up to do. I'll go and have a look at the ASX. So here we have a 4-hour chart of the ASX, and that was left pretty uninterested by the non-farm payrolls on Friday. Really, it finished at 70.80, pretty much where the ASX itself closed. So the futures finished pretty much unchanged. The 4-hour charts aren't really telling us a lot, but given the rampant commodity prices, copper and iron ore in particular, I think the Aussie market is beginning to look a little bit cheap, and I suspect that eventually we are going to take out this sort of 71.15 level. And if we can take that out, then the all-time high. So we've got this sort of 71.10.50. The all-time high is up here around 7200. Now, the thing that's going to work against the Aussie market here, I think, is probably the chances of a higher Aussie dollar. But having said that, it still does look cheap to me, and I think come next week we will probably see the market move up and test this, give this 71 to 10 level. We've got this trend resistance up here, that's sort of 71.60, 70. We haven't even come close to that yet, so that if and when we get there, that'll provide resistance. But I would be buying on dips, I think. I can't see the market coming down an awful lot at the moment. Support's now 70.40 or so, something like that. 70.45, 50, but eventually I think we're going to take out that level, 71.15, head on to that 71.65, and then to the all-time high at 72. As I say, the 4-hour charts not showing us an awful lot. The dailies equally, they're pretty flat, and the weeklies equally not showing us an awful lot. But the thing I do like on the Aussie market is that the monthlies, let me blow this up, the monthlies are pointing higher and they're not overbought. So I suspect at some stage, if we can take this 7200 out, then we're going to see renewed buying interest, and I think the Aussie market could move quite sharply higher down the track. We wait and see on that one, but that's my view there. So all things look pretty positive unless you're long the US dollar at the beginning of the week. And what I'll do is, just before I finish the video, we'll just go and have a quick look at the calendar. Okay, so starting here with Monday the 10th, it could be an interesting day for the Aussie. We've got the NAB's business confidence, we've got the retail sales, and we've also got the FDI numbers coming out from China. And then on Tuesday, we've got the Chinese CPI, which will be a big day, and also the new home sales for the Aussie. So I think early in the week, the interest could lie there. There isn't much else out on Monday. Oh, we've got the Centex coming out of Europe, but that's about it. Then the NzdUsd will come out on Tuesday from Europe. Not an awful lot early in the week from the States. Wednesday sees industrial manufacturing, UK production, and the GDP, monthly GDP figures, as well as we've got quite a bit of inflation numbers coming out this week. CPI comes out of Germany and the US on Wednesday, so they'll be the main events of the day, I guess. Thursday all looks pretty quiet. It's a holiday in Europe, so not an awful lot going on. But we have got the PPI coming out later in the day from the States, and then finally Friday we finish up with bits and pieces, culminating with the US retail sales figures and some secondary data coming out of the States. The industrial production, capital utilizer, and the Michigan, the consumer sentiment index. So that's about it for the week. I think we could see a bit of action on Monday as people reposition following the non-farm payrolls. But with the lack of any real action apart from the inflation data on Wednesday, it wouldn't surprise me to see a week of some consolidation around here. But ultimately, I think basically we're going to be looking to sell US dollar rallies, buy dips in the Euro, Aussie in particular, and probably sterling as well. So we'll leave it there for now, and we'll talk to you next week. Cheers.